Welcome everyone to today's NOVA presentation, 401k Loan and Distribution Basics with Melissa Cawood. Before we get started, I would like to point out the question mark icon at the top of your webinar screen. This is where you are entering any questions you may have for Melissa. Feel free to submit your questions at any time, but keep in mind that the Q&A portion of this webinar will be held at the end. If time runs out and you still have questions, you can send them to our email address, webinars@nova401k.com. Right next to questions, you will see a little paper icon. This is where you will see a drop down for handouts where you can find today's material in PDF form. If you are unable to view or click on the handout, you can go ahead and send us an email and we will provide you with that PDF. If you are with us today to earn continuing education credits, please be sure to stay until the end to fill out our pop-up survey. This will allow us to track your time and participation. Certificates will be sent out within a week for those who have met the time requirements. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates, or visit our website, which is www.nova401k.com/webinars. Thank you so much for joining us. I would like to now introduce today's presenter, Nova's head reviewer and trainer, Melissa Cawood.
Thank you, Yvette. All right, let's get started. So we're going to go over the basics of loan and distribution requests. And before we kind of dive into it, I do want to let you guys know that this is going to be a presentation that is general in nature. It's not intended to be a substitute for legal or tax advice. Also, the sheer amount that we could go into, there's just not enough time in the day to dive into all the minute little details or go over every example. So it is going to be a more general in nature. If you need actual like legal or tax advice, we'd want you to contact an attorney or an accountant. And then if you just need to dive into maybe your plan specific situation or you have questions about your document, feel free to reach out to your account manager here at Nova or the distributions team. As Yvette was mentioning, if you need any kind of credit, there is our provider number on the screen right there. You have to register individually, be present for the entire seminar, and then complete the evaluation form that's going to be sent to you. And within a week, you'll have that certificate. On the agenda, we are going to go over the basics of distributions first. Then we'll go into loan basics. We'll talk about vesting and how that is going to affect the participant loan and distribution requests. And we'll look at some of the most common problems. And I'm going to wrap it up with cybersecurity, how to keep your participants' data safe. We can never talk about that too much. It's always good to have a refresher on that. For our learning objectives, we want to make sure that at the end of this webinar that you understand which distributions are mandatory and which ones are optional from these 401k plans. And we want you to be able to identify your loan provisions and any loan requirements that exist in 401k plans. And then also know how vesting is going to apply for any loans and distributions made from your plan. All right, let's start off with our distribution basics. The first thing that you need to know before we get too far into this is that these accounts are not like a savings account. They're not even like an IRA. They have different rules. And when money goes into a 401k plan, it has to meet certain criteria before it can be taken out of that 401k plan. We call it a distributable event. Basically, a participant cannot just say, hey, I don't want to do this anymore. I don't want to contribute and I want to take my money out. They can't just do that at any time. They have to have an event that triggers their ability to make withdrawals. And that's not an exhaustive list there on the screen, but these are the most common ones. Anytime they're a termination of employment, retirement, if they meet the requirements for an in-service distribution, it's typically age 59 and a half for that. If they experience a hardship, if the participant passes away, then their beneficiary would be able to take the funds out of the plan. If the participant becomes disabled, and rollover money is actually very special, and it is not subject to all the rules like the other money types are. So those typically can be taken at any time. They don't need a separate event in order to make that happen. That's very surprising for a lot of participants. They think oftentimes that it's more like a savings account or more like an IRA where they can just request a withdrawal whenever they want. And unfortunately, it doesn't work that way. We have to have, an actual event that triggers it. So just wanted to point that out. The most common way that money leaves a 401k plan is because the participant has terminated their employment with the plan sponsor. These are voluntary distributions that are initiated by that participant. A participant who terminates does not have to move their money if they don't want to. They can let it sit there for 10 years if they want to. But commonly, they'll take their money once they leave that plan sponsor's company. The funds cannot be removed from the plan until at least the day after that termination date. Their final day worked. While they're still working, the funds cannot leave the plan. I typically see participants, especially when they know they're retiring, they'll go ahead and I'm going to retire at the end of the month, and they'll go ahead and make their distribution request in advance. And I know they're just trying to get everything taken care of while they're still employed, make it easier on them once they have left employment. But we cannot process it until after that termination has actually happened. If it's just a couple days away, Nova will go ahead and hold on to that request, and then we'll process it as soon as possible. If we're a month or more out, we're going to deny that request and ask them to resubmit it a little closer to their actual termination date. Another thing to consider is the final payroll contribution. If the participant terminates today, but their final paycheck is on Friday, and they're going to have a contribution come out of that final paycheck and go into the plan, we might want to consider holding that distribution request until after that contribution has posted to their account. Now, Nova is not going to deny somebody's distribution just because that final contribution hasn't posted yet. They may need every penny they can get today, and the participant may have the opinion that, oh, I'll just deal with the other money later. I don't know their situation. Nova won't know. So as a general rule, we're going to process requests when they come in, as long as they're in good order. But it's just something to consider, something for your participants to consider. If we process the distribution before the final contribution posts, then they potentially could have additional fees to take out that last contribution amount. They also may have to fill out paperwork again. And I know that can be really annoying for the participants. That is going to depend on your specific record keeper. Some record keepers won't make the participant do anything extra. They'll realize it's the last contribution. They'll follow the instructions on the distribution form they have on file. Other record keepers are going to make them do new paperwork. So I can't tell you exactly here in this webinar how it will work, but it's just something I want you guys to consider. Okay, now the second type of distribution kind of goes along with the first, but instead of it being a voluntary thing, this is involuntary. This is also for terminated participants. And this is for those participants who have left the plan sponsor's company, they don't work there anymore, and they have smaller account balances. If they do not choose on their own to move their money, then the plan can process involuntary forced-out distributions, sometimes called mandatory distributions. And what it will do is take those small balances, it will pay them out and get them closed so they're not open in the plan anymore. This is great because it limits your lost participants. If a participant leaves, the company and they forget that they have a plan and it's 10 years later and you're trying to track people down, it can be kind of a headache. So this kind of limits that possibility from happening. Also, for the plan sponsor, it keeps the plan clean. Once those accounts are closed, those participants are not included in your 5,500 count. I know, you have participant counts on your quarterly invoices. That number goes down, meaning your bills are lower, and it just helps to keep the plan clean. So what happens is the participant terminates. They're given a notice like, hey, you've got money in the plan. if you don't move your money, you take it cash or roll it over and you leave it in the plan and your account balance is less than our force out threshold, then we will pay your account out for you on your behalf without your consent. And then if 30 days passes and the participant hasn't made any kind of election, the plan is going to process a distribution for them, and it's going to be based on what the plan document actually says. There's two different force out thresholds a plan can adopt, and it's just dependent upon how your plan is written. Your plan can say any participant with less than $1,000 is going to be forced out, or your plan can say any participant with a balance less than $7,000 can be paid out. Participants that have rollover balances are handled a little bit differently, and it's based on how your plan document is written. Some plan documents include the rollover money with the other account balances to determine if the participant is under that threshold, and some plans are going to exclude the rollover money. I think most NOVA clients have plans written that exclude the rollover amount, meaning more people can be paid out involuntarily. It just helps to keep the plan clean, but of course, as a plan sponsor, you would know which situation fits your plan and your company better, and if it makes sense for you to include the rollover money, then it would be written that way. All right, so for the people with balances under 1,000, typically what happens is that a cash distribution is made. The account is paid out in cash to the participant. This is going to be a taxable distribution for them if they are under the age 59 and a half, and they may have that 10% early withdrawal penalty apply. What will happen is 80% of the balance is going to be sent in a check and mailed to the participant. 20% of that balance is going to be withheld for federal income taxes. And the participant's going to get a 1099-R the following January to help them pay their taxes. The biggest issue with this way of processing these is that it usually creates an uncashed check issue for the plan. So it solves one problem and then it gets these accounts closed out, but it creates a different problem. If the participant didn't move their money the first time, that generally means that the notice they received in the mail wasn't opened. Sometimes people think that this is, spam or it's just junk mail and they throw it away. They never even open it and look at it. So if the check isn't cashed, then you have this other issue. It's going to become stale dated, and then at some point we're going to have to deal with uncashed checks. One option to combat this is that instead of choosing to pay the participant in cash, you can roll over to an IRA that you open on the participant's behalf. Now, in order to do this, it has to be elected in your plan document. But what you can do is put, the minimum rollover balance and set it to $1 so that anybody, regardless of, how much money they have, as long as they have under the force out threshold, is going to be moved to an IRA. For people that have balances between $1,000 and $7,000, cash is not an option under IRS regulations. The IRS says that those balances can be forced out, but they have to be rolled over to an IRA. Basically, we would open an IRA on the participant's behalf, have the record keeper for your plan move the money to the IRA, and then you don't have to worry about an uncashed check. The IRA provider will do participant locator searches and send out quarterly statements to the participants and try to get them to take their money. They kind of take on that headache for the plan. And then the accounts are closed in your plan. You have lower participant counts, no uncashed check issues, and it's just a much smoother situation. We do work mainly with a company called Qualified Trust Company for those IRAs. But every record keeper, just about every record keeper, has an IRA solution available if we're doing force outs. There's also other companies like Millennium Trust that exist as well. So if you have any questions about processing these for your plan, you can contact us. The email from my team is right there at the bottom of the screen, and we'd be happy to look at what your plan document actually says and then how we can process these for you. All right, moving on to the next most common distribution type. This is going to be in-service distributions. These are an optional plan provision. Your plan does not have to allow in-services at all. And then if it does allow them, this is going to be a voluntary distribution that the participant can take if they're eligible and they want to. It allows the employee to take a distribution while they're still employed with the company. And they're sometimes called age 59 and a half distributions because the IRS regulations state that while in-services are allowed, you cannot take employee deferrals, Roth deferrals, or any safe harbor money before the age of 59 and a half. So because of that, most plans are written, if they're going to allow in-service, they allow them at age 59 and a half. There's restrictions available. You may want to allow these, but you may want it to be a little bit more restrictive, and that's perfectly fine. You can restrict the sources that are allowed to be taken. You can say, I only want employee money to be taken, and any employer money they have to wait until they terminate. You can write your document that way if you want to. There's also restrictions you could place on the number of in-service distributions somebody can take in a year. You could say 1 per plan year if you wanted to, as an example. You could put waiting periods in between the requests if you wanted to. They have to wait 6 months before they can take another one, that kind of thing. In this situation, that early withdrawal penalty is not going to apply because the participants would already be 59 and a half. So that penalty only applies to people younger than 59 and a half. Now, they still have to pay federal income taxes, but they will not be charged the penalty tax on top of it. So if a participant did an in-service and they chose cash, they're going to have 20% withheld for federal income taxes. They'll get a 1099-R the following January, and they'll file their taxes like normal. These can also be rolled over to an IRA, and in that situation, no taxes would apply at all. All right, then we have hardship distributions. This, again, is an optional plan provision. Your plan does not have to allow hardships. But if it does, it's going to give access to that account in the event of an emergency for the participant. Again, with these, you can restrict things in here to make it to where you don't have as many processed. You can restrict the sources. If you want to say just employee money, you can do that. If you want to, you can put a minimum hardship amount in there as well. You can say no hardships are allowed unless it's at least $500, or as an example. You can also put restrictions on the number of hardships that can be taken in a plan year, things like that. With these, they are not eligible for rollover. So if the participant needs money to pay a medical bill, of course they're not going to roll that to an IRA. They need the cash. So these are subject to federal income taxes, but because they're not eligible for rollover, the participant can choose how much taxes they want withheld, and they can choose 0 if they want. If they need all the money that they can get and they want to worry about taxes later, they can do that. You have to survive today, right? So while it would be smart to go ahead and have the tax withholding, if they can afford that, if they can't, that's okay. The 10% penalty tax is going to apply if they are under the age of 59 and a half. And so with that penalty tax, it's not based on your tax bracket at all. It is 10% every time for everyone under the age 59 and a half. And then the federal income taxes, that's based on their tax bracket, and that's going to be, charged to them as well. And it's on top of that 10%. These distributions are considered by the IRS to be a distribution of last resort. So if the participant has rollover money they can take instead, or if they're eligible for an in-service instead, they are supposed to take those withdrawals first. It's only when they have no other options to them distribution-wise in the plan that we would allow a hardship. Also, the way the regulations are written, if the participant has savings if they can borrow the money from a family member, if they have a credit card, they're supposed to use up all those other sources first before we consider a hardship. And the reason is these accounts are not designed to give you emergency funds. They're designed to help you save for retirement. So if we're draining them before we retire, the money's not going to be there. With these, documentation may be required. Things like invoices, bills, estimates, in some cases, receipts. Generally speaking, you cannot be reimbursed. You can't put it on a credit card and then turn around and take a hardship to pay off your credit card. That would be considered paying off debt, which is not typically a reason. But we'll look at it in just a minute. Some situations, receipts could be accepted. And then the other thing is the participant is going to have to sign off on a certification. And if they do it through like the record keeper's website, that certification is built into the request itself, and so they're covered there. Some record keeper forms have it built into the request form itself. If it's a situation where it's not built in, then we will send that certification out to the participant to have them sign. Let's look at the actual, what is a hardship? So there's two different ways to define what a hardship is in these plans. And one is kind of called facts and circumstances. It's a little bit outdated of a term, but it still kind of helps to explain the situation. Basically, we don't have a clearly defined hardship reason in the plan. Instead, the participant would come to the plan sponsor with their, story, their need, and the plan sponsor would determine if it's a hardship or not. So if that participant comes to them saying, hey, I want to buy a new TV before Super Bowl, that's not a hardship, that's a want, that would be denied, right? If the participant comes to the plan sponsor saying, hey, I have all these medical bills because, I was just diagnosed with cancer, that's going to be a hardship. That's pretty black and white. But there's some gray areas too, and it can be really difficult to tell what's a hardship. And then sometimes it can be difficult to make sure you're applying the rules uniformly among all your participants. So it's not something that most plan sponsors are really eager to sit down and be the judge on all these things. So plan sponsors wanted a clearly defined, give me a list of what's a hardship and what's not. That way it's just easy and the same for everybody. And so that's what the IRS did. They came out with this safe harbor definition for hardship, and this is what most plans are going to use. And they have 7 reasons here. We've got purchase of primary residence to prevent foreclosure or eviction on your primary residence. If you have unreimbursed medical expenses, post-secondary education, this is going to be college, university, trade school type situation, not private school for your 3rd grader. It's going to be the post-secondary. Casualty losses, which is repair of damage to your principal residence. This has to be something like the way it's written is that it should be due to an event that was sudden, unexpected, or unusual. So, for example, if somebody says, I need a new roof because mine's 20 years old and it's starting to leak, that's not a hardship. That's wear and tear. That's to be expected. Everybody knows that they're eventually going to have to replace their roof. But if they come to you and say, hey, the storm last night blew a tree down and it landed on my roof and crashed in, I need a new roof, that's a hardship. So we have to look at the exact situation for those. Burial, funeral expenses. And then the last one is the newest one, and it's kind of similar to the home repair, but it's a little bit more in depth. This one is any kind of hardship that was incurred as a result of a federally declared disaster. In this situation, it could be home repair. It could also be things like car replacement. If, there was a flood and the car was completely totaled. It can be if, you lost income because you couldn't go to work because we were dealing with the storm. That lost income would be considered a hardship. So this particular reason is the only one where a participant can be reimbursed. If, let's think there's a major hurricane coming and you have to board up your windows and you have to evacuate your family. Maybe you have to order a generator, all those things. At the beginning, you're just trying to survive the storm. So participant can purchase these things, could take care of their family and save those receipts. And then those receipts can be turned in and they can get a reimbursement for that. All the other reasons we would not accept receipts as documentation. For the federally declared disaster, it has to be declared by FEMA. That we're going to look at the county that the participant either lives in or works in. If they live or work in a county that was declared for individual assistance as a result of that disaster by FEMA, then we would allow them to take the hardship for it. If it was only declared for public assistance, then they would not be able to use that hardship reason. All right, there's been a ton of changes to hardships in the last several years. And I actually had somebody ask me not that long ago why I'm considering 2019 as super recent. Why do I keep talking about all these changes? Like by now, shouldn't everybody know? And the answer to that is no. A lot of plans are smaller. Maybe they don't process hardships every single year. And I am still asked, like this very first bullet point as an example, I was asked this 2 weeks ago. Well, wait a minute, doesn't my participant have to take a loan first? So not everybody knows what the changes are. So since 2019, we had a law change, and as of January 1st, 2019, participants are no longer required to take loans. Before they were, because a hardship is considered a distribution of last resort, and they wanted them to take the loans first. Loans are great. They're not taxable. They're paid back. So they don't hurt you from a retirement standpoint as much as a hardship does. What the IRS did not consider is that loans have to be repaid, typically through payroll deduction, which means the participant's getting a smaller paycheck, which for a lot of people ended up causing this cycle where they were, stuck and getting smaller paychecks and then getting behind, and then the next month they're a little bit more behind, and then the next month, and it just created another hardship for them. So the IRS took that requirement out. They also, before 2019, investment earnings on the employee deferrals could not be taken. And it was sometimes a little bit of a headache to figure out, okay, I know this is much money is in their deferral account, but you had to figure out how much was earnings and how much was what the participant contributed. And, if a plan had switched to record keepers or anything like that during the year, sometimes it was really tough to figure that out. And so there's no reason for that to be in there. It's all employee money. So they took that requirement away as well. Another thing that prior to 2019 was on the books is that people had to stop contributing to the 401k plan for 6 months after they took a hardship. Number one, that was hard to remember. You'd have to set something in payroll to start and stop the contributions. But then number two, it unfairly punished participants. I think the IRS's kind of opinion was that, hey, if you're struggling to pay your rent, maybe you shouldn't be contributing to the 401k plan. And, I can kind of see that. But so many hardships were done for a one-time random or freak thing. A participant had a freak accident and had some medical bills. That doesn't mean they're struggling every month, or a tree fell on their roof. That doesn't mean they're struggling every month. So it was punishing people because of, assumptions that were being made that just did not need to be in existence. So they took that out as well. And prior to 2019, Safe Harbor money, QNIC, and QMAC contributions were not allowed to be touched by hardship distributions. And now they can be if your plan document allows it. Again, you can put whatever source restrictions you want in your document for these. Okay. Then we had another law pass, and this is effective for years beginning after December 29th, 2022. Plans can choose to accept participant self-certification instead of requiring documentation for hardships. Now, this does not mean documentation might not always be needed. It just shifted the burden from the plan sponsor to the participant on maintaining that documentation. So if your plan allows this, which most of them now do, then the participant can sign the self-certification. They basically check the box for the situation that applies to them. They are certifying that they don't have any other sources of money to take this hardship, that they do have documentation of their need, that they'll keep on file. They have to sign and date it, all these things. And then the participant is just supposed to keep their documentation in their own files. If an IRS auditor wanted to see the documentation, they would go to the participant. For the plan audits, for the plan sponsors, a plan sponsor is not going to get in trouble if a participant lied on a self-certification. That's going to be between the participant and the IRS. It's not going to harm the plan. We've talked to several auditors, and they've all agreed that they would rely on the self-certification of the participants based on this new law. So they have to complete that. It's going to lead to faster processing, less paperwork, and less red tape for participants. It also helps them keep their documentation private. Sometimes the documentation is medical bills that are itemized and include very personal things about the participant's health that they don't necessarily want to share with the world. Now, NOVA does have very specific ways that we safeguard that stuff. We do have to take HIPAA training because we do encounter medical things for participants, but it just makes the participants feel a lot more comfortable when they know that they're not having to share their medical bills with somebody that they don't know. It doesn't mean that the participant can just take a hardship for any reason. They still have to qualify for that safe harbor reason. They're still certifying on that document. But it does an easy administrative burden for the participant or for the plan sponsor as well. And it just makes it all around faster to process. We're not having to put these hardships on hold while we get appropriate documentation anymore because we can use that certification for them. Your plan does not have to allow self-certification. As a plan sponsor, you will know your participants best. You will know kind of the situation. I've talked to a plan sponsor who flat out told me, I don't trust them. They will lie. I don't want to do self-certification. And that's okay. You can still require documentation in your plan document if you want to. But for most plan sponsors, they are very happy to allow the participants an easier way to access their money in times of an emergency. Okay, I could talk about hardships all day, but we're going to move on to the rollover source. So participants who have rolled money into a 401k plan, that can come from an IRA, it can come from another retirement plan, but if they have rolled it into your retirement plan, then if the plan document allows, they would be able to take that rollover money at any time, at any age, for any reason. And most plan documents allow this as a very standard thing to allow. It is so great because it encourages the participants to roll over into the plan. If your plan document doesn't allow this, the participants might not want to roll it over to your plan. They might want to keep it at an IRA or something, or just take cash and just have it in their savings, because if they're worried about being able to access it in the future, if they know that they potentially have a need, or if they're just worried that maybe one day they will have a need, they might not want to roll it in if your plan's not going to allow them to distribute it at any time. But we want more participants to roll into your plans, right? We want to encourage participation in the plans. The more participation in your plan that you have, sometimes the easier for passing testing it is. And ultimately, also, we're all in here. Our main goal is to help people save for retirement. That's what I want to do. And that's what the record keepers want to do. We want to help people have financial security in their retirement. So the more money that we know is not being cashed out, but is being saved inside these 401k plans, the better off we're going to be. With rollover money, they can roll it to another IRA. If they find out about some IRA with a certain investment option that they're interested in, they can roll the rollover. But they can also take cash if they want to. If they do take cash, it is going to have that 20% federal withholding apply. And then they will be charged that 10% penalty tax if they're under the age of 59 and a half. They'll get a 1099-R the following January to help them file their taxes. Okay, death distributions. It's not the funnest topic, but it is an important thing to cover. With these death benefit requests, the funds are going to be distributed to the beneficiary for the participant. We hope, pray that we have a beneficiary election form anytime we have a participant pass away. But I will tell you, I review on average one death benefit every single day. And the days I don't have any, the next day I have two. And most of the ones I see, and I've been at NOVA for 18 years, most of the ones I see do not have any kind of an election made by the participant. So please, please, please encourage your participants, if you yourself don't have one, get these designations created and get them on file. It makes everything easier when somebody does pass away. It's never an easy time. It's never a fun time. But if we can make sure that we are, carrying out the wishes of the participant, it makes it faster for the beneficiary to get their money. And then we know that that participant is having it handled the way that they would want. These designations should be maintained by the plan sponsor. For NOVA, as an example, if we were trying to maintain them, we would not know if a participant gets married or if a participant gets divorced. We're just not going to have that kind of information. So it's best for the plan sponsor to maintain these. With a married participant, they have to name their spouse as their beneficiary unless their spouse signs off on it. So even if we have knowledge that the participant was married, we're still probably going to reach out and ask for that election just in case somebody else was named. Most people, what I see is that they're married, and so they think that they don't need to make an election because they know that their spouse is going to get the money, and that's fine. But sometimes people do pass away at the same time. It was a month ago that I had a situation where a participant and their spouse were both killed in a car accident. And, they never named a contingent beneficiary. And so it can just make it a little bit tricky sometimes to figure out who's supposed to get the money without that election made. So if an election is not available, it was never created or whatever the situation is, we are going to turn to the plan document to figure out who the beneficiary is. It will state the order of distribution. And on the screen there, we have spouse. If no spouse, it's going to go to the children in equal shares. If no children, it's going to go to the surviving parents in equal shares. If no parents, it's going to go to the estate. Your plan document does not have to be written this way. I've seen a plan document where it went spouse, children, siblings, estate. So either way, we're going to look at the plan document and we're going to use that to help us figure out who should get this money. Also, any death request needs to be accompanied by the death certificate. And this tells us information, obviously, about the participant. It's also going to tell us if they were married or not and the spouse's name. It's going to tell us an informant name and relationship. And it'll tell us the manner of death. We had a situation where there was no beneficiary election on file and there was no spouse. So the children were supposed to get the money. The daughter was very proactive, filled out the form, sent it in, and told us that she was the only child. But then the death certificate showed a son was the informant. So we do look at that, and we will reach out. And anytime there's any questions whatsoever, we will work with the plan sponsor to make sure that we have the right person or people as beneficiaries. If we do have more than one beneficiary, each one will have to fill out a distribution form and then to make their own elections, and then the funds will get split at that point. Some record keepers will allow the forms to come in one at a time. And, if there's two beneficiaries, for example, they will process 50% for the one and just leave the account for the other one to, claim when they're ready. Other record keepers require all the forms to be sent in at the same time. So how we process that may vary depending on your plan situation, but definitely bring it to us and we will help walk you through all of that. Okay, now let's talk about required minimum distributions. Sometimes they're called RMDs, sometimes they're called age 73 distributions. I do not like calling them age 73 because it has not always been 73 and it will not stay 73 forever. It used to be 70 and a half, then it was 72, soon it will be 75. So RMDs is what I call them. It's a requirement that makes certain employees or participants take cash out of the 401k plan once a year. And IRAs have an RMD requirement as well, but it is not calculated the same. And IRA calculations are done completely separate from 401k calculations. With an IRA, the participant can kind of consolidate their IRAs and they only have to take out one RMD. With these 401k plans, if the participant has money in multiple 401k plans, they have an RMD requirement in each plan. And so that's multiple withdrawals that have to be made. The RMD amount is going to be based on their 1231 account balance of the prior year. And we're going to look at their age and look at the IRS's life expectancy tables and find their factor based on their life expectancy. And there's a formula that's how we determine that required amount. That amount is not eligible for rollover. So if a participant wants to do a rollover and move their money, let's say to their IRAs to consolidate everything, if they've already hit that age in which RMDs are required, we have to calculate the RMD first. And then we can roll over the remaining balance. Number one, it's just not eligible for rollover based on IRS regulations. But number two, because the amount is based on the 1231 account balance of the prior year, the IRA provider would not have a way to calculate the required amounts because they're not going to have access to that balance. So who has to take RMDs? Any participant who is terminated will have to take them once they reach age 73. So if they turn, 73 this year, and they're terminated, then this will be the first RMD. If you own more than 5% of the company, then it does not matter if you are employed or not. Once you hit that 73 age, you are required to start taking these distributions. So Nova does this for all of our clients. In early fall, we begin working on this. We look at every plan. We identify all the participants who are going to be meeting that age requirement. And we will prepare forms and send them out to the plan sponsors. It's important to note that it's whatever your age is as of the end of the year. So if we start working on these, let's say in September, and a participant is 72 in September, but their birthday is in December, because they will be 73 before the end of the year, we are going to include them and we are going to go ahead and send you their paperwork. The first year you are required to take an RMD, you can delay that until April 1st of the following year. Every year after that, you have to take it by 12/31. It's just a yearly amount that has to come out of the plan. Most people do not wait until April 1st. They go ahead and just take it. There's a couple factors you got to think about there. One of the biggest ones is if you wait until April 1st, then that second year, you're going to have a distribution come out in the first quarter, and then you're going to have your second year RMD come out as well. So those added together, these are taxable distributions, and the participant will have to pay taxes on both RMDs. So some people don't want to have to worry about that, and they go ahead and just not wait until April 1st. But we'll go ahead and send it out to you. If your participant wants to wait, that's fine. We will keep track of that for you. The other thing to note about RMDs is that once you start them, you can't stop them. I like to joke that they're like Pringles. Once you pop, you can't stop, if a participant terminates employment at 73, but then comes back to work at 75, I've seen that happen. RMDs have to continue. If you're an owner now and then you're not an owner later, RMDs have to continue. Once they've started from the account, they have to keep going. All right, let's talk about quadros. These typically come up in the context of a divorce, but they could also come up in a situation when somebody owes back child support. What it does, it's an order that is going to be signed off on by a judge that awards a part of a participant's account to somebody else, an alternate payee. The rules are very complicated, and it is definitely not a one-day process. What typically happens is the couple gets divorced, they have a divorce decree. The decree mentions that so much is owed to one spouse from the other spouse's 401k plan. Well, oftentimes people will send us the decree and say, here, process this, but I can't. The rules that govern these 401k plans collectively are called ERISA. And ERISA is written to be very protective of the participants. And so in order to pay out a participant's account to somebody else, I have to have an order that clearly defines everything. And the list, it's like 20 something points that have to be included. Things like the plan name, the details for the participant and the alternate payee, the exact amount, whether dollar or percentage, evaluation date. It must state how Roth is handled, how outstanding loans are handled, things, all kinds of things in here have to be included. And divorce decrees are just not specific enough typically to cover all of these things. So what will happen is they will create a qualified domestic relations order that's based on kind of the intention of the divorce decree. Then it gets signed by the judge. And then once we have that, we can have the alternate payee fill out a distribution form with their elections on how they want to receive the money, and we can get it to the record keeper to process it. So it's definitely not a one-day process. And if you have a participant, you're one of our clients and you have a participant that brings you a quadro, just send it to us. We will work directly with the alternate payee, so you and the participant don't even need to talk to them. We will take care of everything for you, have everything completely filled out, so you just can look it over as plan sponsor. The plan sponsor would sign off on anything we do, and then it would go for processing. We will do all that heavy lifting for you. All right, quickly, let's talk about spousal consent. Most 401k plans do not require spousal consent. Even if they do, then it's not going to be required for distributions less than the force-out threshold, which is almost always $7,000. I think the intention there is like, if I don't need the participant's consent to move their money, then I don't need the spouse's consent. If they have more than the threshold, then if the plan required it, I would need to get it. But really, the only plans subject to spousal consent are plans with like old money purchase plan money, and then defined benefit plans. Any plan to where an annuity is a common form of distribution, then that's a situation where we're going to look at spousal consent. Sometimes people ask me about that. Spousal consent was much more common in the past. It is definitely not common anymore. All right, tax notices. Whenever a participant is making a distribution request, they must be given a special tax notice. If they make a request on the record keeper website, the tax notice is given to them as part of that process. Most record keeper forms, if you download them from the website, they're going to have the tax notice attached. So it makes it really easy. You just give the participant the packet. If you happen to have a situation where the tax notice is not included, then you do have to make sure you provide that to them. The tax notices are required because that's what gives the participant information on what to expect as far as how their distribution will be taxed. And more importantly, it tells them how to avoid being taxed. Basically, it encourages rollovers because then the participant doesn't have to be taxed. It helps them save their money for retirement, things like that. It's going to give them all that information on whether or not that 10% penalty tax applies to them and what to expect about mandatory withholding versus optional withholding. All right, so this, I've kind of already covered this, but just to recap, if the distribution is eligible for rollover and the participant chooses cash instead, there's 20% mandatory federal withholding that is done. The 10% penalty tax is not going to be withheld from their payments, but it is something that the distribution code on their 1099-R will indicate that they are subject to this tax. And so when the participant does their own taxes for the year, that's when that will come up. If the request is not eligible for rollover, so like a hardship or an RMD, there is no mandatory withholding. They will still have to pay taxes. They still may be subject to that withdrawal penalty, but they don't have to choose any withholding. Either way, the 1099-R will have the tax code that tells the IRS what they were subject to, and then it will show the amount that they chose to have withheld. For rollover distributions, there are no taxes involved whatsoever. So these are good in the sense that the participant doesn't have to worry about it. They will still get a 1099-R, but it will show the taxable amount as 0, and the code on there will indicate that it was a rollover. All right. Now that we've talked about distributions for so long, let's hit on some loans. So participant loans from 401k plans are optional. Your plan does not have to include this provision at all if you do not want to. But a lot of plans do because it allows employees access to their 401k plan funds, and that encourages participation. Again, some participants are just nervous. They can I afford to give up part of my paycheck? And, they all agree that saving for the future is good, but sometimes people struggle to survive today. And if they know that if an emergency comes up or something, they're going to have access to their funds, they're much more likely to participate in the plan. You can make the provisions in your plan as restrictive as you want to. You can restrict based on the sources that the loan can be taken from. You can say the plan only allows loans from employee sources. You can put in restrictions on the number of loans. You can say one loan at a time. You can put a waiting period between loans. Once the loan's paid off, you have to wait 6 months before you can take another one. These are just examples. You can put minimums in your plan so that people aren't taking a loan for $500. Basically, any kind of restrictions you put is going to lessen the number of loans that exist in your plan. Loans are not taxable because they are paid back. And payments should be done through payroll deductions. So that way you're not waiting on the participant to hopefully remember to make their loan payment that month. If your plan does not allow loans and you want to add them in, we do have to get an amendment done. So definitely reach out to your account manager. Okay, there are some things that are going to be the same for every single plan. And one of those things is the maximum loan that a participant can take. So this rule is an IRS regulation. Every plan has this rule the same. Participants can borrow 50% of their vested account balance up to $50,000. That max amount, $50,000, is also reduced by their highest outstanding loan balance during the last 12 months. That part in parentheses is the part that most people are not aware of. And I have an example a little bit later on that we'll look at that kind of where this comes into play. So I want to make sure you might not need to know how to calculate it. You can rely on us to calculate that for you, but I want you to know that this rule exists. NOVA recommends that you restrict your loan policies to only allow one loan outstanding at a time, add a minimum loan amount of $1,000, and don't require spousal consent. There's typically not really a need for that. The IRS is perfectly fine with us adding minimums. You just cannot have a minimum that's higher than $1,000. Okay, some more restrictions, or more requirements, I should say. The IRS states that the loans have to come with a reasonable rate of interest. Reasonable, I know, can be defined a little bit differently from person to person, but typically what's done across the industry is that people use the prime rate, and it should be defined in your loan policy. But typically, most plans that I see have prime rate plus 2% as the interest rate. And, basically, loans from 401k plans should be pretty close to a loan interest rate that I would get if I was going to go to my local bank and request a loan. There is absolutely no requirement for us to be looking at the participant's credit score or anything like this. At the end of the day, it is their money that they're borrowing. They're borrowing from themselves. So we don't need to get into credit scores and all that. We just need to figure out a reasonable rate. Some plans do use prime plus 1%, things like that. But, as an example, it would not be reasonable for a loan policy to say the interest rate is 1%, because that's nowhere near what somebody would be getting from a bank right now. Now, rates change all the time as well. So that's why most plans like to use the prime rate, because as the prime rate changes and, the atmosphere in the US changes, your plan interest rate is going to change right along with it. The IRS also states that the max time a loan can be outstanding for is 5 years. They do give an exception for loans that are taken for the purpose of purchasing the participant's primary residence. Those are called residential loans. And they do allow the loan policy to state whatever length of time you want there. I've seen 10 years, I've seen 15, 20, 30 years. Last year I processed a loan for somebody that was in their 60s for 30 years. The loan policy allowed it, and that's fine. But one thing that we do want people to think about is, what is the likelihood that your participants are going to be employees for that length of time? Is this person in their 60s still going to be working for the company in their 90s? I guess it's possible, but probably not. Even most people, regardless of your age, don't stay at a company for 30 years. Some people do. I hope I'm at Nova for 30 years, but it's just something, we kind of like when the loan policies are a little bit more the shorter length of time, 10 years, 15, maybe even 20. If a loan is not repaid, remember, if they're being done through payroll deduction and your participant terminates their employment, that loan can't be repaid anymore. So it's due immediately in full. And if it's not paid, then the entire amount is taxable. The outstanding balance is taxable, and it defeats the purpose of taking the loan. So we want to build loan policies that help us avoid loan defaults as much as possible. So it's just something to think about. These loans should be paid through payroll deduction. One thing to note is that they are paid on a post-tax basis. So you run your payroll like normal, and at the end, you take out the loan repayment amount that's sent to the record keeper, and then the participant gets the remainder in their paycheck. Well, if the loan was funded using employee deferrals as an example, you've already paid taxes on it out of your paycheck, and now it's going back into the plan in your deferral account. When that participant retires and they take their money out, they will have to pay taxes on that deferral amount again. It's not, anything. It's just something to be aware of. Something that the participant should realize there's cost to them taking the loans, and they will lower the amount that they otherwise would have had in retirement by taking a loan. Even if it's completely paid back, it will ultimately lower that amount. So while loans, I myself have taken a loan from my 401k plan. I'm definitely not saying loans are wrong or anything like that. I just want people to be aware of how it works. Loans become due upon termination of employment. Again, there's not really a way to pay the loan back anymore if you're not getting a paycheck. So it's very, very important at the end of the day to make sure that the loan policy, it meets the IRS requirements and that it is followed. If we process a loan that does not follow that loan policy, it will be considered a prohibited transaction by the IRS. It will turn from a loan to a taxable distribution. So the participant will have to pay taxes on the entire loan balance, not just whatever was outstanding. And they're going to be subject to the early withdrawal penalties if they're under the age of 59 and a half. So we don't want that to happen. We want to make sure that all loans are processed appropriately. There are fees for taking loans. There is an initiation fee that is charged by both Nova and your record keeper. There is going to be maintenance fees. These are only charged by the record keeper. Nova does not charge any maintenance fees. Typically, they're monthly. I think that's the most common one, but I have seen some that are annual, and I think there's one record keeper that has quarterly. What you need to know is that the participants bear those costs, though. These fees are going to come straight out of their account. It's not going to be on your invoice as plan sponsor. When a participant is ready to take a loan, their first thing they want to know is how fast can they get the money. So we recommend that you understand the process for your specific record keeper and kind of know how to help a participant answer these questions in advance. We recommend apply for the loan online if that's available. It is so much faster for the participants. And then also have them request an ACH payment instead of getting a paper check in the mail. Whether they request ACH or paper check, the record keeper is going to send the money at the same time. But with the paper check, waiting on the mailman, I don't know exactly how long that's going to take. Whereas with an ACH, I know within 2 days they're going to have that money, maybe 3 depending on timing. But either way, the participants need to allow sufficient time to receive funds. Again, like I said in the beginning, a lot of participants think that this is more like a regular savings account, and they think it's going to be just as fast as getting a withdrawal from their savings account. And it's not, especially if we're doing things on paper and we're not helping them increase the speed of this. So if they need the money tomorrow, definitely should have requested it already, but anything, if you need something expedited, let us know and we will help you the best we can. All right, let's look at some examples. This first one's really easy, but participant A, they have a vested account balance of $2,000 and they're requesting a loan for $1,000 and they're going to pay it back in 2 years. We have to look first at the plan document. Our plan document here allows one loan at a time, and they have a minimum $1,000 loan withdrawal requirement in the plan. So we look, the participant does not already have a loan outstanding, so that's good. We look at their maximum loan. Vested account balance is $2,000, 50% of the vested account balance, which would be $1,000. $1,000 still meets the minimum withdrawal, so we would approve this loan request. Example B is a little bit different. They have a total vested account balance of $2,000, but that includes an outstanding loan of $400. One thing to note, the loan itself, even though that $400 might not be physically in the account, it is still considered part of their account balance. All right, so they're requesting a new loan of $1,000 and they're going to pay it back in a year. We look at the plan document. This plan allows 2 loans outstanding at a time. He only has 1 outstanding loan, so he could take another one. But they do have a minimum withdrawal of $1,000. All right, so we have to look at what his max loan would be based on the rules. We look at 50% of their vested account balance. That's going to be $1,000, which matches the minimum withdrawal allowed, but we have to account for that outstanding balance. That $400 loan balance has to be subtracted from the maximum loan amount, which means it only leaves him with $600 eligible to be taken for a loan. Because the plan has a minimum loan of $1,000, we would deny this loan request. All right, example C. This is the example I promised you kind of in the beginning. This participant's vested account balance is $100,000. So 50% of that would be $50,000. They borrowed $30,000 in February, and then a month later, they fully repay it. Then the month after that, they apply for the second loan. We have to look at, I know 50% of his vested account balance is $50,000, but how much, can I give him $50,000 today? I can't, because what was in the parentheses in the beginning? That $50,000 is reduced by the highest outstanding loan balance in the last 12 months. In his case, that was $30,000. So the maximum amount we would let this participant get for their second loan is $20,000. This really comes into play. Most people don't understand this. We had somebody a couple years ago who knew they were going to have a pretty big expense, but wasn't sure exactly how much they were going to need. They borrowed $40,000. Then they realized, oh no, I really needed to take the full 50. They did not talk to us ahead of time. He just paid off the 40,000. He hadn't spent it yet. He was waiting for finalized numbers to come in. He went ahead, paid it back, and then he sent in a second loan request for the full $50,000. And we had to tell that person that their max loan amount was $10,000, and he was devastated. So what I recommend is if you have a participant who is going to pay off a loan and knows that they're going to take another loan immediately after, have them talk to us first. Let us calculate what their maximum loan would be before they go ahead and pay it back, and then they don't get exactly what they think they're going to get. If they have a small account balance, this is not going to come into play. This comes into play when people are really close to that $50,000 maximum loan. So we will do the calculation in advance. What he should have done is just kept the $40,000 and applied for a second loan of $10,000. That we could have processed, but then he would have had the full 50, but in that situation, because he paid it back, we couldn't give him the entire balance back again. It's a little bit complicated, and a lot of people don't understand why this would be the rule. The reason it's the rule is the IRS really does want these account balances to grow. They want the participant to encounter some restrictions where at some point they don't have a choice but to let the money sit and grow. Because the ultimate point is to save for our retirements. This is not just a savings account, a rainy day fund, anything like that. This is for, it's supposed to be contributed to and left alone if possible until we need it in our retirement age. All right, when we have loans, we also inevitably are going to experience loan defaults in a plan. They will happen, but we do want to avoid them whenever possible. So, some recommendations: do not allow your participants to make loan repayments on their own. Don't trust that your participants are going to remember to pay their bill every month, because they might not. They might forget. The check might get lost in the mail. There's all kinds of things that could happen. If it is made through payroll deduction, then the participant doesn't have to do anything. Your payroll will take care of it. It's going to get sent in automatically. We recommend that the loan payments, once you get that amortization schedule, immediately set the loan up in your payroll system. Review the start date. Enter a total goal amount, which should be the number of payments multiplied by the payment amount. And that way your system can turn it off as soon as that goal amount is reached. And then another thing to keep track of is leaves of absences. This happens a lot. Participant, for whatever reason, they take a month-long vacation, they go on maternity leave, whatever the situation is. Sometimes people are out of work and they're not getting a paycheck for a period of time. If you have a participant in this situation, reach out to us and let us know. It depends on your record keeper how we will handle it. For some record keepers, ask the TPA to keep up with that, and we will do that for you. Some record keepers they keep up with it. And so we'd have to let them know. What we should do is have the loan frozen. Now, interest is still going to accumulate on the loan, but they can take up to a year where they're not making payments without it defaulting. And then once the person comes back to work, you'd let us know, and then we would be able to get you a new amortization schedule that you can follow for the rest of the time that loan is outstanding. And that prevents the record keeper from just defaulting it. If we don't tell them about leaves of absences, basically what happens is the record keeper notices payments are missing, they'll send you a warning, and then if they still don't get payments, they default it. Most record keepers do not require the plan sponsor to sign off on anything. They just take care of it. Some record keepers do, but the ones that don't, like it's a really big deal if it's, oh my gosh, no, they were just on a leave of absence. So let's proactively tell them about these things. If a loan is defaulted, the outstanding balance becomes taxable. And again, that penalty tax is going to apply for anybody under the age of 59 and a half. So it can create a tax burden for the participants, especially if it's a larger loan. Okay, if you do have a situation where you have missing loan payments, but yet it's not been defaulted just yet, we still have options. The first option is to make a balloon payment. This is typically going to be for the participants whose payments are smaller and who maybe only missed a couple of payments. If they can afford to, what they would do is have one amount that catches them up. Like, I've missed 2 payments, so I'm going to look at 2 payment amounts. I'm going to adjust it for the interest that's accumulated on the loan, take that out of their next paycheck, send it to the record keeper, get back on track, and then from there, you just follow the amortization schedule. But a lot of times participants can't afford that, and that's okay. If they've missed kind of a lot, or if their payments are larger and it would be too much for them to kind of make multiple payments in one paycheck, what we can do is re-amortize the loan. Again, sometimes the record keepers will do this, and sometimes the record keepers will ask the TPA to do it. So just come to us and we'll help you know what the situation is. If the record keeper will do it, we'll go with you, to the record keeper and ask them to do this. Basically what we do is we're going to increase every payment on the loan a little bit to absorb the amount that has missed, so that by the end of the loan, by that maturity date, it is completely paid off. And we make sure that the record keeper is aware of it, so that even though their payment amount that they're receiving is maybe different than originally expected, they know it's good and they will not default the loan. There is a grace period built in to the regulations, so you have time to get these missing payments fixed. And they're going to happen. People are going to go on a leave of absence. People, maybe you change payroll providers and the loans didn't get set up quite right away. Maybe somebody in HR misses one and they didn't set it up right away. It happens. It's going to happen. That's life. So that's why there is a grace period built in. The grace period is kind of a mouthful. You have until the last day of the calendar quarter following the calendar quarter in which the first payment was missed. So if a participant misses payments in January, they're going to have until the end of June to get it fixed. If they miss payments in March, they still have until the end of June to get it fixed. So you're going to have at least those 3 months, no matter what. Some people get closer to 6. It just depends on when the first payment happened. But definitely, as soon as you notice an issue with a loan, reach out to us, let us know, and we will help you get that back on track. All right, let's talk about vesting. Vesting is just an employee's ownership right to the benefits in the plan that is going to be accumulated or accrued over time based on a schedule that will be in your plan document. Basically, the participant has to earn the employer money types. There's already 100% vesting for any employee money, but Safe Harbor, QNEC, and QMAC contributions are also included in that. The vesting is typically for funds like employer match, employer profit sharing. They might get those contributions, but they have to earn them by working years of service for the plan sponsor. There's 2 different ways we can define what a year of service is. This first one is called the hours method. This is the most common one. And basically, the year is going to be calculated on the plan year. And 1 year of service is going to be credited for each plan year that the participant works 1,000 hours. You can, in your plan document, write a smaller number of hours there. I've seen a plan document that wrote 750 hours. You cannot have your plan document say more than 1,000. That would go beyond what the IRS allows. But it's typically 1,000. It takes somebody working 40 hours a week, 6 months to hit 1,000 hours. So if you work 20 hours a week, you will hit 1,000 hours in 12 months. So they look literally at the number of hours you work during the plan year. And then every plan year that you have at least 1,000 hours, you're giving credit for 1 year. Then they add up the number of years that you get credit for. They compare that to the schedule in the plan, and that's how we figure out the vesting. I have some examples at the end that'll show that. One thing to note is that vesting is calculated from the date of hire. It is not calculated from the date that the participant enters the plan. Most plans you have a waiting period before you're eligible to participate. And we completely do not look at that at all for vesting. We look at the date of hire. The IRS does allow equivalency method to be used instead of hours. Not everybody has hours tracked. If you have salaried employees and you're not looking at how many actual hours they worked, you can use the equivalency method. It will be defined in your plan document. Most of the time, it's defined as 190 hours per month that the participant worked. But you can define it, so many hours per week. If you want, there's different options available that you can write into your document. The other way to do it is called elapsed time method. This is my personal favorite just because I never have to reach out and look in your payroll to find out how many hours somebody worked. It's literally just using anniversary dates. So if they're hired January 1st, I just go January 1 to January 1, 1 year. It does not matter how many hours they worked at all. And it's just a little bit easier to me, a little bit more like black and white. I'm literally counting anniversary dates. If an employee was terminated and came back to work and they were only gone a short period of time, they were gone less than a year, then we throw out that time they were gone. We act like the termination never happened. And we're literally just counting. If they were gone more than a year, then I'm going to look at the first employment stint, count up the number of years. I'm going to look up the second employment stint, count up the number of years, and then I will add them together to see how many years of service they get. All right, example A, a participant has been credited with 2 years of service with ABC Company. They have what's called a 3-year cliff. You're 0%, 0%, and then all of a sudden after you work 3 years, you fall off the cliff and become 100%. Well, with this person only being at 2 years, that corresponds to 0% vested. They have $5,000 in their deferrals and $3,000 in match. When they take their distribution, they are only going to receive $5,000. That $3,000 in match is going to be transferred to the forfeiture account because they did not earn that employer money under the schedule determined by the plan document. Participant B is a little bit different situation. They have 4 years of service with XYZ Company. This plan uses a 5-year graded schedule, and they have these account balances. So 5 years is just every year you're going to earn 20%. After 1 year of service, the employee earns 20% of their profit sharing. In this case, they have profit sharing. And then every year it goes up by 20% increments until after 5 years, they get all of the profit sharing. This person has 4 years, which corresponds to 80%. So looking on this next screen, so if safe harbor contributions and deferrals are always 100% vested, so they're going to get those balances. The profit sharing money is the one that's 80% vested. So they're only going to get $800 out of the full $1,000. The remaining $200 is going to be transferred to the forfeiture account in this situation. Your plan document can have all sorts of different schedules. There's a 6-year grade, a 4-year grade. So just look at the document to determine how it should be calculated. If you have any questions about that or about a specific person's vesting, you can definitely reach out to us. At the end, I'll have my contact information on the screen. Okay, quickly wanted to talk about how to avoid the most common problems. We call these NIGO requests, not in good order. And we're typically, like with loans and distributions, participants forget to sign the paper forms, we're missing pages, we can't read what they've written down. All these kind of situations can be solved by the participant requesting the distribution or loan online instead of using paper. The most common thing I'm missing from a participant for their loan request is the length of time they want their loan. I don't know why, but people always forget to fill that in on the loan request form. If it's online, the system will not let them submit it without having answered that question. So the online really does help to limit NIGO like a lot. With the distributions, the most common thing I'm missing is that termination date. We recommend that when somebody terminates, go ahead and enter that date into the record keeper site. Number one, we will check there before we email you or call you for the information. We know you're busy trying to run your company, and we want to reach out and bother you as little as possible. So we'll check the record keeper site first. But number two, if they do request a termination online, the record keeper will fill that information in from their system for us. So it just makes it a little bit faster. With hardships, we are frequently missing the hardship documentation or the certification. So that's the common one we do have to reach out for. But again, online has the certification sort of built into it for a lot of record keepers, so that can help. All right, let's finish it up by just mentioning cybersecurity. The kind of files that we receive, census files, deferral files, all those things there, distribution and loan forms, W-2s, K-1s, Schedule Cs, all of these have sensitive participant data on them, data that we do not want to get into the wrong hands. And we treat your participants' data the way that we would want ours treated. We have, so many measures in place, but we really need you guys to help us keep it safe. So if you are going to send something that does have sensitive information on it, like social security numbers, dates of birth, things like that, don't send it to us via email unless that email is encrypted. Even then, we would prefer you to use our secure web portal right here. There's a link to it, plan sponsor link. You can safely send us things there. We even have Nova Distribution set up like an employee. So if you have a distribution or loan form, you can choose Nova Distributions in there and send it to us. Anybody on the team can access it. So even if I'm out of the office, one of my teammates can get it for me. With email, when you send something, now it's in my inbox and it's in your sent box. And so it duplicates information. And, if somebody's email was phished, the first thing they're going to do is surf through every single folder looking for whatever they can get their hands on. And sometimes people forget, oh, this is in my sent. You have to delete it out of your sent and then delete it out of your deleted. I need to make sure I delete things out of my inbox and then delete them out of my deleted. So it just, by duplicating things, it leaves it more vulnerable. So that's why we prefer the web portal. We can send things to you and you can send things to us there. We also have lots of things that we do to help make sure that we are thinking about better and constantly evolving and how we are protecting all the sensitive data. We will not add a planned contact unless a previous existing contact has authorized them. For example, John Smith can't just call us up and say, hey, I'm the new primary contact for this plan. He might be, but we need to verify that before we just start sending him things. Every Nova associate, regardless of their job at Nova, has to do mandatory training every single quarter. And then each team has additional training that has to be done with regards to fraud prevention and cybersecurity. I know the distributions team has mandatory training every 45 days. We are constantly thinking about ways to make things more secure and more safe. We have password policies. Yes, we would change our passwords every 90 days, but we also use the software that helps us to make sure that our passwords are extremely secure, and it monitors for data breaches and things like that. So we are constantly being proactive in there. With that, We do have the reminder about that CPA credit. You will get that evaluation survey, so keep an eye out for that. And then, yeah, I'm ready for questions. I have our participant line on the screen and our team email box. Everybody on the team has access to this. So, if I'm out of the office, or if you're talking to a specific distribution specialist, it's always a great option to email the team directly, because then if somebody's out of the office, somebody else can grab it. But I do have my direct information on there as well. With that, do we have any kind of questions?
We did have one question come in. If there's no beneficiary on file, will the probate court take care of it?
So the 401k probate court is going to apply for the participant's estate, but the plans are going to have a list of who the beneficiaries will be. If it is determined that it's going to go to the estate, at that point, that's when probate would take care of those funds. But as far as like, if the person had no beneficiary election form on file and they had a spouse, it's going to be paid. The spouse is the beneficiary. If no spouse and they had children, the children will be the beneficiary. We would like to avoid it getting to probate if we can. So,
Alrighty. Looks like that's all the questions, so we'll go ahead and close it out. A reminder, if you are wanting the handout for today's session, you can click on the little paper icon at the top right-hand corner of the webinar screen, and that you'll be able to download today's material in PDF form. If you are not able to download it, you can email us and we'll send you that handout. For CE credit, just be sure to stay till the end and fill out the pop-up survey, and we will be sending out the certificate within a week. For any other questions, you can email us webinars@nova401k.com. To view any webinars you may have missed and the recording of this session, you can follow us on our YouTube channel, which is Nova 401k Associates. Thank you so much, Melissa, for your presentation today, and thanks again to everybody for joining. We hope you guys have a great day. Bye.